Welcome to the debate. Welcome to breaking news to trading moves.
Glad to be here.
Today, we are looking at the charts we stare at every single day. Specifically, the diagonal lines we draw across them.
Ah, yes. The classic trend line.
Exactly. There is a core tension in how traders approach these lines. We are exploring a highly specific question today. Are trend lines a vital visual tool for organizing price action and reading market tension? Or are they a subjective, potentially dangerous illusion that traps traders by obscuring the true mechanics of liquidity and positioning?
Right. And that tension gets to the absolute core of market mechanics. Are we trading reality or are we just trading our own drawings? Because I fall firmly into the camp that relying on them is a major risk.
And I, of course, take the position that trend lines, when applied correctly, are essential contextual guides. I mean, they let us read market rhythm, detect momentum changes, and build a comprehensive trade plan.
Well, we definitely have a solid disagreement here.
We do. I know what our listeners are thinking right now. But I have made money trading off a perfect trend line bounce.
Oh, I'm sure they have.
Right, they definitely have. But the underlying reason for that bounce is where we disagree. From my perspective, trend lines bring much-needed order to what otherwise looks like chaotic price action. Now, I will immediately concede that beginners mistakenly treat these lines as guaranteed walls or, automatic entry signals.
Which is a very dangerous habit.
Exactly. But their true value lies in reading behavior. We use them to see whether buyers are actively defending higher levels or whether pullbacks are controlled and whether momentum is starting to slow down. Without a visual guide, detecting these subtle changes in market structure becomes entirely overwhelming.
I hear that, but that flexibility you just described is exactly why they are flawed. I mean, they offer a false sense of security. Markets move based on liquidity, resting orders, catalysts, emotion, and risk.
Not the lines themselves.
Right. Not because someone drew a diagonal line on a screen. The lines are merely psychological comfort blankets. Think about the subjectivity involved here. The human brain is hardwired to find patterns, even in pure noise.
Sure, we look at clouds and see faces.
Exactly. We look at random price fluctuations and see perfect geometry. Two traders looking at the exact same daily chart will draw completely different lines.
Well, maybe slightly different.
Sometimes completely different. One trader connects the extreme candle wicks. Another connects the candle bodies. Another might even force the line to match a personal bias about where they want the market to go.
You mentioned traps, and that subjectivity is exactly what terrifies people about those picture-perfect textbook trend lines. But let me give you a different way to look at that subjectivity. The precise placement of the line matters far less than the behavior it highlights.
How so?
Think of it like the bank of a river. The line isn't a brick wall stopping the price. It is the riverbank.
Okay.
The exact edge might get muddy or move slightly depending on the rainfall, but it visually tells you the direction and speed of the current. Drawing the line forces the trader to actively analyze the price action. It prompts you to ask, are buyers stepping in earlier each time price drops? Are the pullbacks getting deeper compared to the previous ones?
I'm sorry, but I just don't buy that the riverbank analogy saves the tool. Let me tell you why.
Go ahead.
If the riverbank is subjective, then the current you are measuring is also subjective. Let's walk through a highly practical scenario. A trader opens a daily chart. They see a low from March and a low from May. They draw a line connecting them.
A standard practice.
Right, but do they use the extreme low of the wick, representing a momentary spike in volatility, or do they use the daily closing price, representing agreed-upon value? Depending on that single arbitrary choice, the line projects into August at entirely different price levels.
But the general direction?
Wait, let me finish. One line tells the trader the rhythm is intact. The other line tells the trader the rhythm is broken. The trader often ends up seeing exactly what they want to see, creating an illusion of structure where none actually exists.
That is a compelling argument, though I would frame it differently. The discrepancy between the wick and the body is precisely why the line is a context tool, not an execution trigger. The riverbank analogy holds because the exact millimeter of the water's edge matters less than the overall pacing of the water.
Millimeters matter in trading, though.
They do for execution, yes. But in a healthy uptrend, buyers defend higher levels. In a healthy downtrend, sellers control the rallies. If a trader draws a line connecting bodies and another connects wicks, both lines are still sloping upward. Both lines force the trader to acknowledge that higher lows are being established.
I guess they do.
And the trend line accelerates the brain's ability to process that visual data. When you have 50 different charts to review, that visual anchor gets you to the right questions faster. Is price respecting the general structure, or is it just drifting aimlessly?
But accelerating the brain's ability to process visual data can also accelerate the brain's ability to make terrible decisions.
How so?
The flexibility you defend is exactly what traps people. When a trader has a bullish bias, they will redraw the line 3, 4, 5 times to justify staying in a losing trade. They will move it from the bodies to the wicks, then to a slightly lower swing point, constantly trying to find a reason why the market is still respecting their drawn structure.
That's fair.
And we haven't even mentioned chart scaling. If you draw a trend line on a linear chart and then change your vertical axis to a logarithmic scale, your perfectly respected trend line is suddenly broken. The line literally moves depending on the mathematical rendering of the chart itself. How can anyone base a serious financial decision on a boundary that changes based on a software toggle?
Hold on, though. You are blaming the tool for the trader's lack of discipline. Moving a stop loss or redrawing a line to avoid taking a loss is a psychological failure, not a mechanical failure of the trend line itself. But your point about resting orders and subjective placement leads right into something we need to explore closely: the danger of consensus and the concept of liquidity traps.
Oh, absolutely.
I will acknowledge that when a trend line is incredibly clean and obvious to everyone, it attracts masses of retail traders.
It certainly does, and this is what we call the clean line paradox. The cleaner the line, the more traders are watching it. You might think that makes the line stronger because of collective buying power, but in reality, it makes the entire area a trap.
Because of where the stops are placed.
Exactly. Let's look at the actual mechanics of this. When an obvious trend line forms, it attracts obvious stop-loss placement. If thousands of retail traders buy the bounce off a rising trend line, they all place their protective sell stops just below that line. If traders are shorting the breakdown of a trend line, they place their buy stops just above it. This creates a massive, concentrated pool of liquidity.
Right, and large institutions need that liquidity to execute their orders without causing massive slippage.
Precisely. Imagine you manage a multi-billion-dollar fund. You need to buy 100,000 contracts of an asset. If you just buy them at market price, your own buying pressure will shoot the price upward, and you will get a terrible average entry price. This is slippage.
So you need sellers?
Right. You need to find a pocket of intense selling pressure to absorb your massive buy orders. And where do you find concentrated selling? Right below the most obvious, widely followed upward trend line. Smart traders, institutional players, algorithms, they don't ask, will this trend line hold?
They ask where the liquidity is.
Yes. They ask, where are traders positioned and what happens if price moves through that concentrated area? The easiest way to find willing sellers is to push the price just below a clean trend line, triggering all those retail stop-loss orders. We call that a liquidity sweep. The retail traders sell out of fear, the institutions buy up all that available liquidity at a great price, and then the market rockets higher. The clean line wasn't a support structure, it was bait.
I am not convinced by that line of reasoning, because you are assuming the trend line itself is the problem, rather than the trader's failure to read the tension around it. Yes, obvious lines attract obvious stops.
Millions of them.
Sure. But that is exactly why trend lines are excellent for tension detection. Before that liquidity trap is sprung, the market usually gives you visual clues, and the trend line helps you spot them. The trend line didn't fail. It perfectly identified the area of highest tension and maximum opportunity. The novice trader gets trapped by it, but the professional trader uses that exact same trend line to anticipate the sweep.
What kind of clues? Because a sudden liquidity sweep often happens in milliseconds. It is a flash on the screen.
The clues happen before the sweep. Imagine price pushing along a rising trend line. Initially, every time it touches the line, it bounces aggressively. Buyers are eager.
Okay, sure.
But as time goes on, the bounces become weaker. The price cannot reach the previous highs. The candles start to overlap heavily. The distance between the price and the trend line tightens. The trend line is acting as a baseline, showing you that the upward energy is fading.
I see.
The line is warning you that a trap might be imminent. Observant traders use the line to prepare for the liquidity sweep rather than fall into it. They see the tension building, recognize the obvious stops resting below, and decide to wait for the sweep to occur before entering.
That is a fascinating way to look at it. But have you considered that you don't need the diagonal line to read that tension? You just described a series of lower highs and overlapping consolidation. Those are purely horizontal structural observations.
I wouldn't say purely horizontal.
But they are. You can see fading momentum by simply looking at the distance between the highs, or by looking at volume drying up on the advances. Adding the diagonal line just introduces a slanted variable that tricks traders into anticipating a specific interaction point. The moment you rely on the diagonal line, you risk ignoring the raw order flow happening at that exact price level.
Wait, I have to challenge you on that. I disagree that horizontal structure is always sufficient. Diagonal lines capture the element of time in a way horizontal lines absolutely cannot.
Time.
Yes. How do you measure the velocity of a trend without a diagonal axis? A rising trend line shows the rate of change. It shows how aggressively buyers are willing to step up their bids over time. When that rate of change starts to decay, the visual representation of price struggling against that specific slope is incredibly powerful. The best use of a trend line isn't prediction. It is this precise form of tension detection.
You can measure velocity through moving averages, or simply tracking the time it takes to form new swing highs. But even if I grant that a diagonal line helps detect tension, we still run into the core issue of what happens when the line actually breaks.
The break is the most important part.
For beginners, they see a break and immediately assume the entire trend is over. They panic sell or reverse their position purely based on a slanted line crossing a price candle.
Which is a complete misunderstanding of the tool. A break of a trend line doesn't automatically mean a reversal. Sometimes it only means the rate of the trend is slowing down. The true power of a trend line is actually revealed in the behavior immediately following the break.
I would argue the line itself loses all relevance at that point. Once it is broken, the structure is gone.
Not at all. The line provides the necessary context to evaluate the new behavior. Once the break occurs, it prompts a highly specific set of analytical questions. Let's talk about the mechanics of a lower high after a break.
Okay, lay it out.
Price breaks the upward trend line. The initial sellers rush in, but then the market bounces. It rallies back up, testing the underside of that broken line. This is the moment of truth.
The retest.
Exactly. If buyers are truly exhausted, they won't be able to push the price above that previous structural point. Volume will dry up on the advance. When price rolls over from that point, the trend line has successfully framed the exact moment the market transitions from an uptrend to a downtrend. Without the line, you might just see a random pullback. With the line, you have a visual thesis of resistance.
But the boundary's arbitrary. That is the point I keep returning to. You ask, does price reclaim the line? But if the line is drawn differently by 5 different traders, then price might be reclaiming one trader's line while still rejecting off another's.
Well,
What truly matters is the raw metric of risk and positioning. If an entry is late, the stop is too wide, or the reward is small, the presence or break of a trend line is entirely irrelevant.
risk management and visual context aren't mutually exclusive. You can have a perfect visual setup and still reject the trade because the math doesn't work.
No, they aren't mutually exclusive, but one must absolutely dominate the other. Let's put numbers to your textbook lower high setup. Say price rallies back to retest your broken trend line at $100. Visually, this is the perfect setup to enter a short trade based on trendline mechanics.
Sure.
But if your horizontal resistance is at $105 and your target support is at $98, your risk-to-reward ratio is terrible. You are risking $5 to make $2. The trendline tells you a story, but the math tells you the reality.
You still need the story, though.
Beginners get so hypnotized by the story the line tells That they ignore the math entirely. The line isn't the trade. The risk parameters and raw price behavior are the trade. If you want real context, look at tools like volume profiles.
Which are great tools.
Right, because they show us exactly how much volume was traded at specific price levels. Or actual order book imbalances, which reveal the resting buy and sell orders. These show where money is actually waiting, rather than where a drawn line suggests it should be.
We actually agree completely on that principle. When we analyze market behavior objectively, the consensus is clear. The line isn't the trade. The behavior around the line is the trade. Experienced traders use trend lines as context, not confirmation.
And that is a crucial distinction.
We combine them with horizontal structure, volume, broader market conditions, and strict risk management. The trend line helps build a trade plan. It doesn't replace one. It helps with defining market rhythm, finding reaction zones, spotting a loss of momentum, and planning invalidation levels. The key word is planning. It highlights an area where a decision may be needed.
But highlighting an area for a decision can also be achieved through those volume profiles, order book imbalances, and basic horizontal support and resistance, tools that actually reflect where money has changed hands.
They serve different purposes.
The danger of the trend line is that it is predictive in its visual nature. A diagonal line projects infinitely into the future, pointing to prices that haven't traded yet. It encourages the human brain to predict rather than react. The better question is never, did price touch the trend line? The better question is, what is price doing around this area, and does the risk make sense?
And if the risk doesn't make sense, the trade relies entirely on hope, and the trend line doesn't matter one bit.
Exactly. If the entry is late or the reward is small, the line is utterly meaningless. The market forces of supply, demand, and trapped traders will run right over a diagonal line without a second thought. The market doesn't care about our geometry.
Let's bring our perspectives together as we close out this discussion. To summarize my stance, trend lines, when stripped of beginner illusions and used alongside solid horizontal structure and volume analysis, are crucial contextual tools. They aren't magic wands, but they effectively map the market's rhythm.
I would say they attempt to map it.
Fair enough. They capture the velocity of a trend in a way horizontal lines cannot, helping us spot the loss of momentum. They provide visual boundaries that prompt the right analytical questions when market structure begins to change.
And to summarize my opposing view, relying heavily on visual, diagonal lines risks falling into subjectivity, confirmation bias, and dangerous liquidity traps.
The clean line paradox.
Yes, the cleaner the line, the more likely it is to be exploited by larger institutional players hunting for stops. Pure market mechanics, understanding where traders are positioned, and strict risk management must always take precedence over a drawn line on a chart.
We certainly share a strong point of convergence here. Both of us firmly agree that treating a trend line as an automatic entry signal or viewing it as a rigid wall that price must obey is a critical mistake.
Absolutely.
It is the post-break behavior, the raw reaction of the market that dictates the true direction.
Yes, looking past the visual line to the underlying order flow is where the real edge is found. There's much more to explore regarding how volume, catalysts, and resting liquidity interact with these highly observed areas on a chart. If you are going to draw them, you have to understand who else is looking at them and how that collective gaze changes the overall dynamic.
Perfectly said. We will leave it to our listeners to evaluate how they balance visual context against raw market mechanics in their own trade planning. Think back to our earlier thought about the river and the current. The next time you draw a line on your chart, ask yourself, are you reading the underlying speed and rhythm of the market, or are you just staring at an arbitrary edge while missing the actual flow of the water?